Hey everybody, Ace here. The end of the year is right around the corner. We're only a few days away. So I want to talk about us finishing strong and how we can lower our taxable income for 2020 and going into 2021. But first, before I talk about the ways on how to lower your taxable income, let's understand how the tax brackets work. Now, there are currently marginal tax brackets, and you might be thinking, I'm not quite sure what that is. So let me quickly break it down for you. The way marginal tax brackets work is you are only taxed for the certain income made within that bracket. So as you're going to see in this chart, there's going to be tax rates between 10% all the way up to 37%. Yes, these tax brackets might change in 2021 under the new presidency, but I'm going to be going over them as they are current because you will need to know them for your 2020 taxes, but things are probably going to change for 2021. So in the 10% bracket is $0 to $9,875. That means you're going to be getting taxed 10%, making up to that $9,875. Then the next tax bracket, which is 12%. You're going to be getting taxed 12% on the dollars you make between $9,876 to $40,125, and so on and so forth. So, for an example, let's say you make $55,000. Does that mean you're going to be getting taxed at that 22% rate for that $55,000? Absolutely not. What it means is you're going to be getting taxed 10% up to that $9,875, 12% from $9,876 up to $40,125, then from $40,126 to your $55,000, you're going to be getting taxed 22%. That's how marginal tax brackets work. As you make more money and you get into the upper brackets, you're going to be getting taxed at that higher percentage. So your whole entire income won't be taxed at that higher percentage, just what you make above the lower incomes. So for instance, you're currently at the 12% bracket and you're going to get bumped up to the 22% bracket, meaning you got a raise from $40,000 to $45,000. Everything $40,000 and below will be taxed at that 12%. Then when you start making dollars above that $40,000, that will be taxed at the 22%. So in reality, only $5,000 of your raise is going to be taxed at that 22%. Now that we've briefly gone over the marginal tax brackets, hopefully you have a good understanding, or at least a rough understanding of how they work. Now I'm going to go into some ways of how you can lower your taxable income. First off, if you haven't been doing it already, it's going to be pretty late in the year to start, but you can contribute to your 401k to lower your taxable income. When you sign up to contribute to your 401k, it's going to put money into your 401k before you get paid. And when it does that, it's actually going to lower your taxable income because what you're taking home is going to be less. Your employer might be able to make some extra deductions for their own tax deduction purposes, but as the employee, you're pretty much capped off at the end of the calendar year. So going into 2021, make sure you're contributing as much as you possibly can into your 401k to help lower your taxable income. Next, you can contribute to an IRA. You have up until tax day, which is typically April 15th, to contribute $6,000 to your IRA. If you're under 50 years old, you can only contribute $6,000 to an IRA. But if you're over 50, you get an extra $1,000 that you can contribute. So that's $7,000 you could write off of your taxable income. Third way is you can sell some stocks for a loss. If you've been trading stocks or holding on to a handful of stocks that have just been doing terrible in 2020, you can actually sell those stocks and write off the loss, which will lower your taxable income. Now remember, if you have a whole bunch of stocks that you've made profit on, if you haven't sold them, you're perfectly fine. But when you do sell them, you're going to get taxed on them. You could either negate this by selling stocks for a loss or accept that you're going to have to pay a lot of taxes on those profitable stocks. But for the purpose of this video, you can sell your losing stocks for a loss and have that written off on your taxable income. Another way is to fund your flexible savings account, or FSA. The IRS lets you funnel tax-free dollars directly from your paycheck into your FSA every year. In 2020 and in 2021, the limit is $2,750 that you can contribute. And contributing to the FSA is just like the 401k. It's going to be pre-tax, which will lower your taxable income at the end. And on the flip side of an FSA, you could also contribute to an HSA. And the last way that I'm going to mention to lower your taxable income, and trust me, there's many other ways out there, but I want to keep it brief for you, is to make charitable donations. Charitable contributions and donations can help lower your taxable income, and they don't just have to be cash. They could be just items as well. Whether that be donating clothes, food, old sporting goods, or different household items, for example, those things can all lower your tax bill if they went to a bona fide charity and you got a receipt. There are many different tax software programs that will let you put in how much money you donated, or if you're using a CPA, you can just give them your receipts and say you've donated so much money, which will help in the end lower your taxable income. Plus, in the end of donating, whether that be cash or old items, you feel good because you know you're helping people in need, which after a crazy year in 2020, everyone could use a little help. And as I said before, there's a lot of other ways you can lower your taxable income. I just wanted to quick touch on a few to help get you some ideas of what you can do in this current year, before 2020 ends, or throughout 2021. If you liked this video or learned anything, please just tap that thumbs up button for me, subscribe for more content, and leave me a comment down below on what you're going to be doing in the new year. I hope you've had a great and safe 2020 and holiday season, and I hope to see you again in the new year.